So now we're going to look at the US-China trade deal, what's happening in parts of Asia. And first, I think the important place to kick off is what is happening with the dollar, what's happening with some different pressures in the market and foreign reserves. We're going to do a whole show next week where we just look at inflation and the US dollar across the globe and what does it mean as a reserve currency. But just to kind of kick things off, it's important to appreciate where China is right now in terms of foreign reserves that are kind of sitting on the balance sheet. And here you can see the foreign reserves are up a little bit, but again, they continue to bleed down some of their other spare capacity. And if you consider what they have backstopping a lot of their debt. So right now they continue to see defaults. They continue to see some issues in terms of the debt, not only at the private level, but also the state-owned entity level. And all of these banks have to have some bad debt expense, and there has to have some collateral. And typically treasuries and US dollars have been a key component for that backstop. It's averaged anywhere from about little over 3 trillion to about 3.2 trillion in US dollar foreign reserves. But the issue is here, as we continue to see a slowdown in trading, a slowdown in global growth, and this starts to reverberate through not only their exports being hurt, but also imports, you're going to start to see some of this pressure. Now, imports have been down pretty big in China over the last 7 months, which has actually helped because even though exports have also struggled, their imports coming down helps that balance, which has pulled in a little bit more additional currency, which is good to help kind of solidify the balance sheet. But it's not enough. And that's the bigger issue because they continue to stimulate, they continue to push through additional lending practices, trying to get more money to the provincial level, and the PBOC trying to really pick things up, which is going to be a problem if they don't see this start to turn, which is why the dollar pressure is going to be real. This looks at Turkey and the other problematic areas. But in this scenario, we really want to talk about China. Now, taking this to the next level and looking at what does that yield look like and what is happening across the different regions, you can see that there is a consistent problem when we start looking at what are real yields looking like. And we're starting to see some of those issues. Now, this one isn't so much about China, but more about India, because the India problem is looking at, okay, well, real yields are going negative. We're seeing that they're not covering inflation. Inflation remains to be a problem. What is that going to do for borrowing? Because even though right now we're going to talk in this segment, we're also going to talk about China, India is going to be a big part of that. So we have to appreciate what's happening with India. And then we're also going to talk about, again, that South Korea component, which while we're seeing something a little bit positive in terms of South Korea, which means that they're going to be able to go out there and actually borrow, it's going to be a problem when we start thinking about India coming to market, trying to help prop things up because they are experiencing a significant slowdown, which is going to continue to reverberate, which we'll touch on. So this one looks at the Chinese 10-year and the US 10-year. And typically they have kind of moved in lockstep for the last couple months, but now we've really seen the Chinese 10-year break out and the yields start to go higher. And this is typically going to happen when there's the investors essentially say, look, I am going to demand a higher yield to take on this sort of risk, which is what we're starting to see in China. And right now, when you look at the US 10-year, things have been relatively stable. They had a little bit of a spike when there was a weak 20-year and 30-year auction, but the 10-year actually came out relatively strong on this most recent auction, especially the 2-year. So it's really a duration risk. So the question is, what country do you feel more comfortable taking duration risk? Is it going to be China or the US? And that's where some of this delta is starting to come in. So this is why we want to keep looking at this Chinese 10-year, because if the dollar remains here and all of a sudden you start to see a little bit more softness in the yuan and the renminbi, you might start to see this 10-year really kind of drift higher and move closer to where we were in 2019, right before we had the move lower as we saw those easing practices. So this is something to watch. And I do think there's going to be a bit more of a pull on the US 10-year as things kind of get pulled higher, just because people are going to demand more interest for their money, especially with the Fed continuing to ease, the U.S. Government putting together a new package for stimulus. There's just going to be a huge deficit to close. So there's just going to be more borrowing that's going to be needed, which means that investors are going to get a little bit more concerned and want more reward for their money. So I just don't think the Chinese 10-year is going to come down. It's more the U.S. 10-year is going to move up higher, and there's going to be more upward momentum on where the China 10-year is going to go. And we're seeing that play out in multiple different levels, because why are people also considering additional risk? And I think it really comes down to some of this uncertainty within China, the health of the economy, where things are going. And one way to look at this is just honing in on what is happening at the actual crude purchases. So we've seen crude purchases within China really come down. We're seeing these breakdowns. This is just looking at ESPO physical differentials versus Dubai, just to give you an idea of where things sit. Like obviously the extreme contango came in, and now we're coming back down. There's these concerns about where is all of this oil going to go? And we're just looking at oil as more of a bellwether for, well, what is happening with demand? What is happening within the country? You know, we've talked about the Yangtze River, the Three Gorges Dam, the issues there, and the slowdown in industrial production. But this is where we're seeing that the most. Like Chinese port congestion continues to keep oil floating storage extremely high. You know, Platts is saying that there's an idled amount of cargoes of about 100 million barrels just sitting offshore. Now take that to the next level, and let's say, okay, well, we have the oil side. Well, let's look at the gasoline and diesel side. So right now we have diesel stockpiles, gasoline and diesel stockpiles rose to a record of 59.7 million tons in July, which is a fill rate of about 75%. Now, gasoline inventories increased 6.3%. To 26.55 million tons. And then we have diesel, which expanded by 9.8% to 33.16 million tons. Now, it's important to consider that diesel is really the lifeblood of the industrial backdrop in terms of shipping, trucking, what's happening in the industrial world. So this is a problem, because diesel continues to grind higher. There continues to be a problem, and we're starting to see those refiners roll back because there's just no market for it. Now, the fill rate is nearing that 80% to 85% level that is considered maximum safe level. So again, this is kind of giving you that backdrop on the pressure that continues to form within China and is going to cause additional problems. Now, when we consider about additional problems, we have to take a step back and look at the Chinese-U.S. Trade deal and what the targets are. So as of the end of July, they achieved 28% of the target. Now, August was a big jump up, but the problem is the jump is coming from their purchase of agriculture, which isn't a problem for us because we want them to buy more stuff. The problem is on their side in terms of food security and their need to go out there and just sweep the market for beans, wheat, and soybeans, wheat, and corn, because they're experiencing such a shortfall, not only because of flooding, but also because of the locusts that came through, swine flu that started out that closed out last year, started this year, and the armyworm that is now in regions in the northern Corn Belt that was never there before. So you're looking at a shortfall. You know, we have this Clean Your Plate initiative. You have all these other initiatives to try to close this gap because food inflation is a big problem within China. They're now being targeted in the Galapagos, saying that they're fishing too close to the reef. You know, there's 156 boats that have been seen turning off their transponders out of the 400 fishing there. So there is a growing problem with food. So here is a natural place to close that gap. The problem is that we're also having issues within the U.S. in terms of the strength of the crops, which we'll talk about. But these are some of those bright spots. But even with all of these moves, we're still so far away from closing that gap. It's going to be near impossible to make up that difference. Now, the agriculture goods and the energy goods are really where we're going to see the most, because LNG is unlikely to get over there, just given the sheer size of the market and what they're getting from Russia, Qatar, and Australia. But energy in terms of purchasing oil is possible. It's just going to be a matter of what are the differentials and what do things look like. But agriculture is going to be one to watch. Now, when we break this down, this kind of breaks it down a little bit differently, looking at where do we sit right now in terms of covered goods. This is looking at the aggregate based on purchase commitment of Chinese imports and then purchase commitment to U.S. exports. So you kind of see the difference in terms of where the separations are and actual purchases based on the different components. Because again, China can resell, they can do a lot of different things. So it's always interesting to see what are they arbing, what are they maintaining, and we're going to start to see those increase, especially as we start looking at the different backdrops. So here's one where we need to look a little bit closer because energy has lagged significantly, and it's just because we had a massive glut at the beginning of the year, which came at the same time when China was experiencing a huge COVID outbreak, which obviously reverberated through the rest of the world. But that put energy at a huge weak point because they just didn't see consumption the same way. They weren't consuming, and they continue to not consume on the same level. Manufactured goods have started to close the gap. The issue is going to be now with Hong Kong and what's happening with Hong Kong and the technology sector, because there's going to be a lot of different components that go into that basket in terms of things of technological goods from chips on down. The one that we're going to see close the most gap is going to be agriculture. But again, you can see how far we are from total commitment, and we're just going to price ourselves out of that market, and we expect to see some of that get picked up by not only Brazil but also Ukraine, Russia, and some of the other markets. But we continue to see this concern about food, and we're seeing it all over the globe, especially in pricing. So agriculture is one to watch, and this is just looking at what's happening in terms of corn pricing, specifically in the U.S., and you can see that it's at a 5-year high. So when you consider things at a 5-year high, you're going to go out there and try to arbitrage, which is why they continue to come to the U.S. and they keep purchasing corn. The next big component is purchase of beans. And here you can see that they've started to close that gap. They're closer to where they were in 2019. I would expect them to try to close this gap. The problem is the health of the bean crop is starting to deteriorate just because of drought conditions and just what's happening within specific areas within the market. Now, taking this to the next level, let's look at corn. Corn conditions have deteriorated for two reasons. One, drought. There's been rainfall has been short. There's been problems there. We also had a massive windstorm that pushed through essentially the middle of the country, and that resulted in not only destroyed crops, which once you bend over a stalk and the stalk is broken, the corn is no longer any good. And there was a huge damage to just crops being literally wind blown down, broken apart, but it also destroyed silos. And you had a lot of corn that was sitting in silos getting ready to be shipped, going into hoppers, that is no longer any good. So this is another problem. So not only do we have a shortage in China due to flooding, due to armyworms and other forms of pests, including locusts, we also have our own problems. So this is why we're seeing those prices continue to go higher, which is also going to put pressure on the consumer because prices will go up. And with prices going up, that's inflation. Those are things that are going to impact the way we continue to purchase, because it's going to take more to just buy the same amount of stuff. That's, anything when we're looking at grains, which is going to weigh on the consumer. So now that we've looked at China, the other entity that continues to kind of fight back and forth with China is India. And India has seen an increase in COVID cases essentially since through July and now into August. August is starting to pare back a little bit. But you can see just the headwinds that we continue to see on the retail side and on the consumer sentiment side. And again, this is all getting really kind of fleshed out with the lockdown indexes actually increasing into August, into the end of August, just because we've seen these new surges in cases that's resulted in lockdowns. And these lockdowns have continued to hinder not only industrial production, but also the movement of products. So this is why we continue to see, as we talked about earlier, the mobility indexes were really starting to kind of roll over. And we're seeing the same thing in South Korea, where we're seeing some of those indexes really roll over, and it's going to weigh on just their inherent industrial production. And how does that play out in India? So in India, it's the same type thing. We want to look at oil product consumption. And here we really look at, because we have to look at fiscal year just because they have a weird fiscal year versus everything else. But about half of India's fleet of trucks is currently idled. Now, just consider the fact that the trucking, I mean, half of the fleet being idled is a huge headwind in terms of moving things around the country, and really shows just the amount of pressure that is coming into the Indian economy. So India's oil product demand is set to slump to this 5-year low, which is what we're talking about. And it's really being driven by diesel, because diesel is down about 22%, with gasoline, or petrol as they classify it, down about 5 to 7%. Now, we think that the petrol demand is going to weaken as well, but it's really going to be pulled down based on where the diesel demand is, because those lockdowns are not only going to impact diesel, but also gasoline. Again, movement of products. And this is also being factored in, because we have seen tax hikes on the industrial fuels. We have seen additional tax increases, and just what's happening with these headwinds, just because they're running out of ways to stimulate, as we talked about at the very beginning, in terms of, inflation has been a big problem within India. They haven't really been able to get it under control. And these are some of those areas that we're going to continue to see problems, which is going to weigh on really where things are going. And that's why here is where we can start looking at oil demand and how the demand is starting to really come off. And you're seeing that really accelerate, and it's coming from those diesel sales that we talked about. And it's interesting to continue to look at what is happening with consumption and overall. Now, the bigger overarching issue, as I mentioned earlier, was inflation. And inflation continues to be problematic within India. And when we looked at the chart earlier, we saw that Turkey was expending a huge amount of foreign reserves. And we actually have India that is accumulating foreign reserves. And they're doing that in order to try to cordon off and really go after the inflation question, because they want to make sure to secure their currency and to not let the inflation get out of hand. And when you look at inflation getting out of hand, how do you do that? How do you adjust that? Well, you cut spending is number one. You cut spending, which is when I talked about tax hikes, which is going to inherently cut spending, because you're not only going to decrease the amount of subsidies you're giving, but you're also going to get additional tax revenue. But you're also raising the price of the product, so it's going to limit the amount of demand. So you're going to essentially shift the way people are consuming to try to cordon off some subsidies while taking in additional tax revenue. But you're also looking to borrow, and we've seen India issue gold-backed bonds. We've seen them looking to do things to essentially bring in dollars to shore up some of their balance sheets. Now, let's take this from the other side. One, they're purchasing less oil. By purchasing less oil, it also means that you're giving away less dollars, because oil settles in the petrodollar, which is denominated in US dollar. So that means that there's just less dollars you're also giving out, and you're still exporting products. So that's helping you bring some more money in. So they're trying to get around and keep inflation from really getting out of hand, specifically here. The problem is COVID continues to result in lockdowns. They continue to struggle to get back to normal, which is why, even though they're doing things to try to cordon off, you're still seeing the inflation creep. You're still seeing some of that pressure, while even though they're trying to manage stimulus, they still need to stimulate to a point to try to get some of this manufacturing back up and running, because you can't have half your fleet sitting idle. That's just inherently showing where the problems are. And this is not something that's going to go away, which is why at the very beginning of this economy segment in part one into part two, we talk about India GDP and why we believe that the India GDP estimates are wrong. We think there's going to be additional pressure. There's going to be additional issues in terms of them trying to get back to only down 5%. And these are things that we're going to continue to watch, which again, China and India are huge demand centers for oil, and we're just not seeing that demand materialize. If anything, they're walking back from where they previously were due to either economic issues, COVID, or inflation, which again is continuing to kind of creep into the market. And India is also subject to food inflation and food pricing and food problems, which now, while they have more to sell and they're looking to sell, that's another thing. Like they're looking to sell some crops. They're looking to get things out there to bring those dollars in. So again, it's a complex question with a complex answer, and there's a lot of different moving pieces to it. But you can see how things can quickly start to unravel, and you can get that contagion. And that's why we're trying to also help them with that contagion to try to backstop it and find ways and solutions through either the IMF, the WTO, or other means to try to help a key, I think, ally really in the fight against or in the way of addressing the Chinese question. So thanks again for watching. We're going to have more to come. We're going to have our primary vision frac spread count. We're going to have our special on rare earths. And then next week, as I talked about earlier, we're going to do really a whole segment on inflation and the US dollar, especially as a reserve currency. And then that's going to lead us into our normal lineup. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.